Hey, welcome to Make Your Money Matter. I'm your host, Brad Barrett, and our show aims to help you create a better relationship with your money. I got my purple shirt on today, so you know it's going to be a good one. And on today's show, I want to talk about some ways that parents, I'm a parent myself, that we can transfer wealth to help our kids. We've gotten a lot of comments and feedback on everything from custodial accounts to trust, and we're going to talk about that today. We get those comments from our clients and from you guys as our viewers. And I think a lot of us can take part in this great wealth transfer in ways that actually won't burden our kids with extra taxes. But before we get started, make sure to smash the subscribe button and hit the notification bell so you don't miss a single episode. All right, let's get into it. Now, I think for many out there, we realize, and I've actually shared this on our show as well, that we're in the midst of a great wealth transfer. And what I mean by that is over the next 20 years or so, baby boomers, if you will, who have built their wealth, are looking to help their children get, let's say, a head start financially. And as they pass, they're going to be transferring. Now, we're in that phase right now as we speak. I know as a financial advisor, I'm working with my clients on this. And we're going to talk about some ways on other shows as well about how they can help with things like first-time home buyers. So stay tuned on that. But I got a lot of comments and responses from our own clients and viewers here and how we do that with things like rising costs and rates. And it's just hard for people to get into houses. So we're going to focus on that. But on today's show, I want to talk about these certain ways that I think are really keen here to help our children through this transfer as this next generation begins. Now, we want to help them what? We want to help them accumulate their wealth. And as they begin on their own journey, we want to help them with solutions and strategies and how we want to evolve on all of that, okay? So as a financial advisor, I think what's most important as I go through a few here is understanding which ones of these work for you. And it has to be a conversation you have to have with your financial advisor. But the first thing I'm going to bring up here is custodial accounts. All right. When a child is young, like I have an 8-year-old and a 6-year-old, so we often as parents will open up a custodial account on the child's behalf. These are known in our world as what's called UTMA or UGMA, which stands for the Uniform Transfer to Minors Act or Uniform Gift to Minors Act. And these are typical accounts, and the parents, they'll open these accounts as a convenience to maybe accumulate things like birthday money and holiday money that the child receives. Now, while the child, if you're watching and listening here and your child is younger, the custodian named on the account controls the assets, and it's actually charged to use the money for the benefit of the child. Now, it's important to remember, though, when custodianship is set to terminate, which, by the way, typically occurs when a child attains the age of somewhere between 18 and 25, depending on your state and your custodian, the legal control transfers to the child. So just keep that in mind. Now, while many young adults would welcome, I'm sure, a sudden inflow of cash in their own name, honestly, as an advisor, I share this openly. It's probably not the most desirable for the child to have immediate use and control over these funds, especially if the account becomes sizable, as some of these accounts with accumulation and growth over time can be. Now, in those cases, I might actually think it wise to instead to consider an alternative structures, things like a trust or an entity like an LLC or a limited partnership to transfer the custodial account assets as opposed to them passing the child outright at the age of majority. Because age of majority, as we all know, I mean, they're still young adults and they still got a lot of learning to do when it comes to finances. Now, obviously, you work this within your own family structure, your own dynamic, and if done properly, these alternative structures can provide some additional controls over the funds, and really, in some cases, a degree of creditor protection as well. And you can look into that, and another alternative would be like to forego the custodial account strategy altogether is to use this trust structure from the get-go if the expedited gift amount is expected to be sizable. So this is kind of a broad stroke here, honestly, on our show to kind of talk through your own individual net worth and gifting or aiding strategies you have with your kids. And so kind of dovetailing off this first one, the second big piece I want to bring up outside of a custodial accounts is funding for things like education or medical expenses. Probably the most common thing I talk about when it comes to helping our children with my clients here at One Capital is helping our kids with education or things that might come up when it comes to medical. Now, if a parent, anyone out there right now finds a child in need of help when it comes to things like education or medical bills, our natural inclination as parents would be to write the child a check and just to help them out, right? That's like innate in us. And all I'm trying to share here with this step is to take a second, right? And especially for my high net worth individuals where things like estate tax or gift tax may be an issue. I think there's a more efficient way to do this to help a child with these type of expenses, which currently, by the way, the estate side of things stands at $12.92 million per individual over one's lifetime. So it's just important to know about, before you just knee-jerk react to things, about helping the child. Now, and remember, talk with an advisor and go through what's best approach for you is, because obviously, as such, any money given to a child, regardless of the usage, would be considered a gift. So I want to bring up, potentially what could be subject to a gift tax, right? There's an exemption to this under the qualified transfer rule. You can look this up. It's section 2503E of the Internal Revenue Code. That just sounded totally nerdy, and you heard it from me. That's true. But it provides a direct payment, which is what I'm trying to bring home here in the second point. Direct payments on behalf of another individual or family member to the tuition for tuition to the school or medical expenses is excluded if it is paid directly to the provider. So just know that in the second piece of helping with education or medical, if you pay it directly to them, it avoids any gift tax implications. Again, talk with your legal, estate planning, and or financial advisor about that for yourself. And the third thing I want to bring up, at least on today's show, when it comes to helping our kids is, if a child's fortunate enough to be a beneficiary of a trust, there may be a natural inclination to make distributions of cash from the trust to assist the child financially with whatever they might need. Now, there may have been a desire to terminate the trust too early once the child, isn't as an adult, maybe has demonstrated ability to handle the money responsibly. I mean, there's things that go on in a family dynamics, but I'm just bringing this one up now. While this is certainly a common use of a trust, I think it's important to examine the situation more holistically before just making a distribution or a termination decision. First and foremost, cash distribution is not the only way a trust can be used to help a beneficiary. It also can be used to purchase assets on behalf of the beneficiary. Think of a first home, for example. It's a great case study, right? Instead of making a cash distribution to the child, the trust that the child is the beneficiary of can actually buy the home as the property owner, and the child as the beneficiary of the trust can live in the home rent-free. Hint, hint there. And secondly, there also may be a tax benefit of keeping assets in the trust if the child is successful in their own right, which I've had examples of this, and does not need the assets in the trust for living expenses. That may be better to let the assets stay in the trust for the duration of the child's life. I mean, I've mentioned this just now, but I have a few clients who've actually been fortunate in this camp, and that's where I want to bring up as an example to have this. And one of them actually was, again, successful on her own right, so it was more tax advantageous when I was talking with her CPA to make sure that we bought assets within the trust to make sure there wasn't any tax implications for her that she didn't need to pay. So again, these are obviously complex, and there's a new generation of wealth here, but as we're still living and working through estate living benefits, right, I think it requires almost a shifting of our wealth planning solutions, which is why I wanted to bring this up. And I think it's really important, right? It's important to talk through legal counsel with your legal counsel and legal analysis on all of this, because it's often worth the extra work if you look at it from a wealth or from a multi-generational perspective to do it right versus just do it right away. Just a thought. Hey, I hope you enjoyed that today. If you did, make sure to subscribe to our channel so you don't miss a single episode. And always remember to make your money matter.